Hi, I'm Lauren Hamilton, accountant for therapists. Today I wanted to talk about four costly mistakes that could be leading to higher taxes for you in your practice. So let's jump into those. Mistake number one is not structuring your business in the correct way. So, as you get started with your practice, maybe you started as a sole proprietor, which makes the most sense when you are getting started. However, as you're growing your practice and reaching that $60,000 to $70,000 income mark, you might want to start looking at becoming a S corporation. And again, this is not going to be for everybody, but if you are in that range, that's something that you want to discuss either with your tax preparer or your accountant to make sure that that is the right move for you. The reason being is you can save on self-employment taxes. So let's look at an example. So let's say you made $100,000 in profit as a sole proprietor. If you're paying self-employment tax, which is Social Security and Medicare, and the rate for that is 15.3%. So you would have to pay 15.3% on that $100,000 profit. However, if you are an S Corp, then you can pay yourself a salary of, let's say, $60,000. You would only be paying the self-employment rate of the 15.3% on just that 60,000, not the entire profit amount. So that's, thousands of dollars worth of tax savings that you would want to capture on. So again, this may not be right for everybody, but you just want to watch when your income levels come up as you're growing and making those decisions that can put you in a lower tax liability. Mistake number two, mixing personal with business finances. I feel like I talk about this all the time because it's just so big. Do not mix your personal and business finances together. I see this happen a lot, so you're not the only one that may be doing this, but if you are, please make a conscious effort to change this. So the common issues with this are if you're, paying business expenses with personal cards, or you're using like your personal bank account for your business expenses and putting money like your business income goes into your personal account directly, or if you're you may even forget to record purchases that you've made on a personal account that were for business, so you're missing out on that deduction. So it just creates a lot of messiness. It creates audit risk. It just kind of creates chaos in your accounting. So my solution for this is just open a business banking account. It's really easy. All you need is your EIN number. You will need to have that set up, which hopefully you have that set up through when you started the business or your practice. There's a lot of great banks out there for business accounts, some that, can be a little bit more beneficial to you, especially if you need a business credit card. Sometimes those have a better interest rate. Anyway, so that's a whole nother video talking about banking. But the main thing is that you just want to keep your business finances separate from your personal. Even if you're a sole proprietor, I mean, the whole point of that is you just want that separation. Because again, if you do get audited, your entire personal accounts can be liable when everything's just all mixed together. Mistake number three, missing year-end tax planning opportunities. So usually we don't think about taxes until like January or February or even March or April. So really it's in that first quarter of the year that you think, oh yeah, I've got to file my taxes. So let me figure out what all I need. By then it's too late to make any tax saving strategies like prepaying for any continuing ed classes for the next year. You could have software renewals that you could pay, before the end of the year to capture that expense. Or if you wanted to prepay your rent, anything like that, you could miss out on paying at the end of the year. Another major planning opportunity would be making retirement contributions, especially if you have a SEP IRA or a solo 401k. Those pay or those contributions have to be made before the end of the year. Some other retirement accounts do let you make contributions for the previous year by the time you have to file your tax return, but some of them do not. Some of them do require you to make those contributions by the end of the tax year. So again, if you're looking in January and you go, oh, I could have, put $10,000 in my retirement account, but now it's too late, you've now missed out on that opportunity. So the best way to do this is just review your income and expenses during the year and just kind of think about those things of what can I prepay, what can I contribute to, anything like that, especially before the end of the year. So tax planning isn't just for big corporations, it's for everybody. And even if you can prepay or, purchase a new couch or chair or whatever, maybe for your office by the end of the year, that can save you, $300 to $400 just in taxes. So it's always good to look at those things before the end of the year. Mistake number 4 is waiting too long to work with a professional. This is not a scare tactic or, anything like that, but as you are a professional in the mental health space, a professional in the tax and accounting space can help you look for these items. They're going to be really on top of the tax laws, any changes and threshold amounts, rules, regulations, compliance, all of that good stuff. And they're going to be able to help you find those opportunities. And so, again, when you are thinking about taxes in January, February, it might be, again, too late to take advantage of some of these things. So, my advice is always to stay on top of it during the year and just do even a quarterly check-in. Just do 15-20 minutes, making sure that your accounting is up to date, that you are categorizing things correctly to the right expense accounts, and that you're talking to your tax professional to say, hey, is there anything that I do need to be aware of during the year that I can take advantage of to make sure that my taxes at the end of the year are, optimized, because nobody wants to pay more to the government than, we need to. So it's always good just to have those conversations during the year instead of the beginning of the year. So again, those mistakes that we discussed are being structured incorrectly, mixing business and personal finances, missing the opportunity to do year-end tax planning, and working with a professional. If you're not sure where to start, I work with therapists all the time in helping them get their structures set up, making sure their accounting is set up correctly, and working with their tax preparer to make sure that they have all of the information they need during the year to advise you on those tax saving strategies. If you found this video helpful, please share it with somebody else who might benefit from it as well. Until next time, be well.